offset accounts and redraw do have separate features, and so I wanted to talk to you about the difference between them today. What I've got here in the background is a loan account of $500,000, and we've also got redraw that we've placed into the loan of $50,000, which means that we're reducing our balance from 500 to 450. So the idea with redraw is that it is placing money back into your loan account itself. It is in that account, that facility. And because you're essentially paying back the bank faster than you needed to, you have access to that prepaid money. You've paid $50,000 early, you can access $50,000 if you still want it. The thing with that is that over time, your balance is meant to hit zero. You've borrowed this $500,000 over a 30-year term. So after 30 years, that facility is closing. It will be closed, which means that this $50,000 is going to disappear over time. And so as we can see over here, when you pay $50,000 immediately, like I said, you've got access to that $50,000. And over time, you'll keep access to it as well. And because you've paid extra, you're actually paying back the loan faster than you need to. It's going to take you 23 years to repay the loan instead of 30. Fantastic. That's a lot of interest saved. But if you wanted that $50,000 to be available forever, even after the loan is closed, redraw is not going to work. You can see that, $100,000 here, $50,000 is roughly here. After year, 20, 21, your redraw is going to reduce, because after that period of time between then and when the loan is meant to close, either being repaid early or just keeping the facility open to the end of the 30 years, you can see that 50,000 is going to reduce to 49, 48, 47, all the way until the end of the term, or when you close the loan, when it hits zero. So if you wanted your redraw to be available forever, redraw is not necessarily going to work. You might need to move the money out at a different time. The other thing to keep in mind with redraw surrounds investment properties and interest. When you have an investment loan, you're claiming the interest charges on the account. And so reducing the balance reduces the interest charge, which is great, like lower cost, fantastic. But putting money into the redraw account itself means that you've actually paid down the investment's debt. And so if you wanted to access this money and then take it back again, are you taking it back for the same investment purpose, or are you taking it back for a different purpose? And that's really important, because when you're claiming interest, you're meant to be claiming costs associated with that investment. If you've taken the money and spent it on something else, a portion of that cost is now for something else. It's no longer claimable. It's no longer deductible as part of your investment calculations, your negative gearing essentially. So redraw is great. It works really, really well, saving you interest, but there are some limitations. Offset accounts are similar, but a little bit more flexible. They are transaction accounts. You could have money in your spending account, a holiday fund, emergency savings. They are just transaction accounts, which are tied to the loan account. Same provider, same lender. And essentially reduce this balance further. So instead of 450, after you've paid down by 50,000 already, you've now reduced it by another 2 and another 10 and another 5. You've now got a net balance of $433,000, which will attract lower interest charges, pay down the loan even faster. Fantastic. That's what we want to do. Pay down the debt fast. Because these are transaction accounts, it's your money. The bank can't take it back when the loan term is finished. It's your money. So if you want your money to be there for a much longer period of time, fantastic. Even when the loan's closed, it's your cash, it's all yours, you keep it. One exception to that is what's called a non-ADI, a non-authorized deposit-taking institution. And what that means is that when they lend you $500,000, you owe them money. That's all they're allowed to do, lend you money. They're not allowed to hold a surplus of cash for you. They're not authorized to take a deposit. They're just repaying a debt, which means if, for instance, this holiday fund went all the way up to $460,000, well, all of a sudden you have too much money in this account and you're not allowed to. You've outweighed your balance, which means you have to reduce this in line with the balance, or forfeit some of the funds. If that lender were to close, which has happened in the past, they could argue that you've prepaid a debt, and so you're only eligible to receive the $10,000 difference as your cash, as a rebate, if that were even the case when they closed. It was just a poor timing. Point is, offset accounts, you don't really want them to exceed the loan balance because it removes the benefit for them. Loan balance needs to be higher than the offset accounts. They don't really work otherwise. Now, on top of having access to splitting your money in multiple areas, multiple accounts makes things easier to track. The other benefit of an offset account is that it's saving you interest on the home loan, but it's also not earning you interest, which means you're not being taxed on additional earnings. Regular savings account will earn you at X%. Home loan is typically at a higher interest rate and it's saving you interest, which means rather than paying tax on the interest that you've earned, you're not paying any tax on the interest that you've saved on the loan. But keeping in mind that if your goal is to see these balances increase, an offset account isn't going to do that. It's only reducing the loan balance. It's not increasing every time interest is calculated and accruing interest and growing. It's just saving interest on the balance of the loan and reducing the balance over time. So, offset accounts all sound well and good, but surely if the bank is going to provide this benefit, they're going to charge you for it. And you're absolutely right. Typically, the bank is going to charge you anywhere between $8 a month, $96 a year, and $395 for the year on what they call an annual package fee or an offset fee. Some banks will just charge a higher rate. Some banks actually charge a higher rate on a basic loan, not an offset. But if we look at this with the same example of $500,000 and a loan term of 30 years like we had before, same interest rate, we just add an offset account fee. Are we actually saving money or not? I've placed the same $50,000 in either Redraw or an offset account, but because I'm able to tie in multiple offset accounts, I'm not just saving interest on $50,000 in Redraw, I'm now saving on $67,000 across all of my accounts, which of course is going to save me more money, more interest. Typically, $5,000 to $6,000 is where an offset balance needs to sit to outweigh this $400 fee. And so because we've got more than that, we're outweighing the charge and therefore our net cost for the year, interest charges, package fees, they're still lower than interest charges alone on the Redraw. So we're better off going with an offset account. Now you might be asking, if I've got money in those offset accounts, that's all well and good, but my money is going to reduce. A holiday is eventually going to be taken. I'm going to spend that money. An emergency will eventually happen. I'm spending money on groceries, kids' soccer, whatever it is. These dwindle and therefore the savings dwindle. And you're right. So we want to make sure that that's being accounted for. How much money on average will we have every single day? And will that outweigh the annual fee? Yes or no? But another way to make sure that that actually happens is to use a credit card. And so what we're seeing here is, like we've discussed, if you're spending money every single week, groceries, bills, whatever it is, your balance reduces. You get paid, balance goes up again. But this reducing balance is saving you less interest. When you tie a credit card, you're spending somebody else's money and your offset account stays exactly the same. So you're consistently saving the same amount of interest against your home loan whilst you spend on the credit card. And when you get paid, and then you reduce it again to clear the credit card. So it's a great way to spend someone else's money and make yours still work for you against the home loan. Credit cards can also offer you points or other kinds of rewards that kind of just snowball the benefit of using them. But they're not for everybody. They have risks. They have high fees. Some have high interest rates if you don't repay them on time. You want to make sure you're disciplined with them and you want to make sure that they're right for you. That's kind of the key with all of this. Offset accounts, Redraw, credit cards, they have to be right for you. So that's why it's really important to speak with a broker and make sure you're getting the right deal. Make sure that your money is working for you the way that it needs to, perhaps tying in a financial advisor to make sure that that's, as maximized as it possibly could be. So there's going to be a link below. Feel free to book a meeting with myself. More than happy to run through these details or have a look at your situation further. I look really forward to speaking very soon.